Manish Sonthalia, Senior VP and Head Equity PMS at Motilal Oswal AMC, joins us on the show with his views on the market. Manish, good to have you. Good morning. What's the call that you're making this morning? I mean, we are at 7,700. The SGX Nifty is suggesting a higher open, so it would be probably a week of positive gains if, today goes on in the green and tomorrow as well. Where does the market really go before budget?
See, I had thought that the markets would see 7,000 first and then maybe 8,000 towards the latter half of the year. Now it looks like we are headed towards 8,000 first and maybe see some correction later on. But I think the renewed confidence in the markets has come from Mr. Jaitley's, tough talk on economy and fiscal consolidation. So definitely the momentum seems to be building up before the budget, and there's a lot of optimism. I don't think markets will see any major correction in the run-up to the budget.
What happens after budget, Manish, is more important. Do you think it could be a case of buy on rumors and sell on news?
And it could be that way, Nikunj. You expect a lot of positive announcements, but much of that has been priced in, especially the investment, infrastructure related themes, and it could be that you could see profit taking in those names, and you could see high quality names again coming back, which has somewhat been muted. But if you see the run up to the budget, these are the names which are seeing some strong hands buying into them. It looks like that there are some very strong hands buying into them, and maybe this is the sector, this is the space which will have outperformance post the budget announcements.
Yeah, but there are a fair number of funds sitting on the sidelines waiting for the budget event to happen. And if, the right noises are made or the right plan of fiscal consolidation is laid out, some of these funds are actually waiting for the budget event to get over so that they can put in incremental capital into the market.
Yeah, that is the dilemma. You have a lot of funds waiting to get into Indian markets, so you're not buying into names. Just looking at the near-term picture, people have started discounting the next 3, 4, 5 years of earnings. So some estimates even put the figures, FI flows at something like $40 billion this year. I mean, we are just at about $10 billion right now. So it's the flow of capital into India which will see exuberant valuations. The domestic institutions have been sellers all this while. Who's going to supply them the good quality names? So you are also seeing a lot of paper being issued into the market. So capital structure gets aligned for the highly leveraged companies. Everything will just go together,
Manish, institutional investors are bullish on Adani ports, and the underlying thought here is that economy will recover and a port company will make money.
Yeah, the port company is going to make money, but where's the cash flow of that company going to be used? That is the moot point. They have an abort point bought at Australia, which requires 50,000 crores. Of course, that's taken off the balance sheet of Adani Port. But the question remains is where the promoter is going to get the cash flows from. So it's a great business, it's a great annuity business, but this whole, asset play which the group has entered into requires a humongous amount of capital. The port growth is going to be there, but it's going to benefit all the ports. So, you'll have a Gujarat Pipavav also gaining share. And you have multiple ports in the country, but this is the single largest port. It has growth opportunities. If the growth revives, it will be seen even in the numbers. But one needs to watch out for the end use of the cash flows of this company.
The problem with some of these asset owners is that they don't have cash flow and they have a huge debt. But courtesy QIP, at least for the moment, some of those concerns would be sorted out. Would you be a buyer in some of these asset owners?
It's like make hay while the sun shines. So, you have the capital structure of these leveraged infrastructure plays skewed highly in favor of debt. And, that bank funding is not going to be forthcoming for these over-leveraged companies where interest coverage ratio is 1 time, 2 times or even less than that. So the whole idea in the up move is to get equity capital, realign your capital structure, reduce balance sheet risk and, to have least dilution possible. So I think one way to look at it is that these companies would be preparing themselves for the next round of growth, but at the end of the day, today they are not making money, and on valuation parameters and the cash flows that you talked about, it certainly wouldn't fit in the scheme of things if you're looking for long-term value creation. Because if you're looking at a 10% dilution, let's say in the case of JP Associates, 1500 crores is what they are raising, and roughly around 242 crores. 242 crore shares they have, so 20 crore additional shares, so 8-9% dilution. I mean, the ROE is only going to get dilutive, so what's the point in looking at the company when your EPS is going to get diluted and cash flows are not there? So definitely we should give this company a pass. I mean, not looking at them at all.
But Jayaprakash Associates, year to date, the stock has done well, and there's also that fundamental trigger, there's turnaround that everybody's expecting, which is why the stock has returned about 40% so far into the year. You do not have it on your recommendation list?
That's the whole thing, that these asset plays are not very great businesses. In fact, they're gruesome businesses, but it's like whether you want to buy into a bad business which is hammered down extremely badly, and then you try to sell them at slightly less cheap valuation. So, that's one way of investing, but, we really do not follow that way of investing. So, yes, the stock has done well, but again, it is just to ensure that there is capital raising and you somewhat get the capital structure right, which was detrimental at one point in time to the survival of the very company. So, because the going is very good, you have optimism about the future, but at the end of the day, markets will value cash flows, and that is hard to see at this given point in time. Maybe in future you could see dramatic increase in cash flows because the capex cycle, the incremental capex that this company would have is minimal. But I would wait to see the cash flows rather than taking a plunge right now.
There is a one-on-one correlation between the currency and between the profitability of IT companies. In the medium term, they can manage, but in the short term, currency fluctuation will have impact on their profitability. The natural direction of the rupee is that it wants to strengthen. So then if the natural direction of rupee is positive, why are IT stocks moving up?
I mean, the natural conclusion is that rupee may not appreciate, because the whole macro dynamics about the trade deficit does not warrant that the rupee appreciate very significantly. Even if it appreciates due to capital flows, my sense is RBI is going to intervene and push the rupee again south of 60 rupees to a dollar. So on a quarter-on-quarter basis, you would be around 3% appreciation on the rupee, so that would impact margins for the first quarter. But again, seasonally, when we look at IT companies, we are looking at sequential numbers. So from a fourth quarter to a first quarter, you're going to see some good jump in top line. Margins are going to be under pressure due to visa costs, wage inflation, currency headwinds, etc. But all that is known by the markets. Markets want to take a slightly longer term picture. But I think, here markets would be segregating the large cap IT companies from the mid cap IT companies. The headwinds on account of currency related things, even lowering of Gartner estimates, would be more adversely felt by the mid cap IT companies and not so much by the large cap IT companies. So, that continues to be one of the favored sectors that we like from a slightly longer term point of view. We'll stick it out. I don't really think rupee is going to appreciate very significantly.
Manish, where are you shopping in this market? What was your last big acquisition?
So I think, I've been positive on insurance very recently. So I bought into Max India again. Bought into an HPCL, we bought into a DCB bank. These are some of the names that we have recently bought in the mid cap space, and large cap just continues to remain the same way.
So why HPCL and why not BPCL? Everyone is of the view that BPCL is a better franchise and they have a global business.
No, so we have bought this into the mid-cap fund, and BPCL is really not a mid-cap, it is a large cap, with 40,000 crore plus market cap. Only HPCL would have qualified as a mid-cap, something like 14,000 crore market cap.
What about autos and auto ancillaries? Have you bought anything there? Because in the sector rotation, they seem to be providing some leadership. The two-wheelers especially have done well, but even from the four-wheelers, I mean, as Nikunj has been highlighting through the session, Maruti has been a standout performer. M&M, Tata Motors are known stories. And I just want to add one more to that list, is Bharat Forge from the auto ancillary pack. I think their numbers have looked very good, the export numbers especially for the last month.
So we continue to stick with our old favorites. Bosch has done extremely well. You've seen the CV numbers from Ashok Leyland. You've seen the CV numbers from Eicher Motors. So Eicher, Bosch continues to remain our top favorites. In the two-wheeler space, we continue to have a position in Hero Honda. Of course, numbers have just been about in line. Slightly disappointing. I would have thought 6 lakhs for the month of June was more likely, but they have come out with 5 lakh 41. So there's some market share that is being taken away by Honda, because that company seems to be growing at 23-24%, industry growing at around 7-8%. So TVS and Honda Corp are taking the market share from Bajaj and Hero, I think we are just positioned that way, don't really have too much of exposure into Tata Motors at this current point in time, or a Maruti, which looks slightly stretched on valuations, even though numbers have been very stellar for the month of June. So, but auto continues to be our top weight sector. I think if our economy has to revive, the auto and the banking sectors will give you the leading indicators.
Well, so Manish has bought into Max India, HPCL and DCB. Manish, why DCB? It's a small bank. They don't have a huge network. They don't have maybe best of the talent. Why have you bought into a small cap private bank?
Yeah, small bank becomes a large bank. So, the founder members are Aga Khan Foundation, which have their, history or pedigree, attached to HDFCs of the world. If you look at the balance sheet, absolutely clean, securitized, secure collateralized lending, very niche market of mortgages, SME, so book is growing at around 24-25%. They would not require capital post the QIP that is required of 300 crores. And we are buying, and we bought it at roughly around 1.6 book on an FY15 basis. So I think growth opportunities are good, balance sheet is absolutely clean, growth is doubling of profits every 3 to 3.5 years, and was available at a very reasonable valuation. So that was the main reason behind buying into DCB.
Manish, give me one name which you're happy to own for next 3 years. Just the name.
HPCL looks very good. I think, oil marketing companies will get re-rated over a period of time. They're making half percentage margins, net profit margins. And today marketing margins are at a loss, and they're just managing positive margins, paying huge amounts of interest. Just on the basis of gross refining margins, this marketing margins will swing from negative to positive once diesel gets deregulated. So even if you assume a 2% net profit margins, you're looking at a 5-fold, 6-fold jump in profits. And what is the bank? What is the company being valued at? One-time book, 13,000 crore market cap, when the profits can be north of 5,000, 6,000 crores. So that's the way to look at it. I mean, I'm looking at it that way, not necessarily the near-term picture but what is there to lose from these valuations? Absolutely nothing. You could see a 4-5 bagger in HPCL, BPCL and IOCs moving to north next 5-6 years.